Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the TGI. Thank God it's Friday, the 4th of February, daily bull versus bear webinar for TradeDay.com. Steve Miley on the call here. We're going to go through our usual run through in here, guys. Calendar, what we've had, what we've got coming up. We're going to take a look at the major macroeconomic, fundamental, geopolitical events that are driving markets right here, right now. And we will take a look at the calendar. Sorry, not the calendar, the charts. We'll take a look at the charts to see how all of those events, all of that potential data, all the geopolitics, all the central bank price action is affecting markets on the charts and where the opportunities might lie. Let's start off with the calendar. I'm going to step back to yesterday's calendar. And the big thing in here from yesterday's calendar were the two central bank meetings. Bank of England raised rates as anticipated. We covered this on the webinar yesterday, but were more hawkish than expected, nearly voting for a 50 basis point rate hike in the meeting, and was just missing that. It was a 5-4 vote for 25, with the 4 wanting a 50 basis point hike. So real risk of a more aggressive rate hike, and certainly looking for a rate hike at the next meeting in March from the Bank of England. Then we had the ECB that came out pretty much on the call while we were on the call yesterday. Not really time to talk about it and digest it on the call, but certainly there was a shift when we went to the statement, but more at the press conference, to a more hawkish tone from the ECB, and now real risk of potential rate hikes this year, real risk of potential for a faster removal of the super easy dovish monetary accommodation that we're seeing at the moment. That took the market a little bit by surprise, but with that shift, we were expecting it to come down the line, but not really right now. The market wasn't expecting it. So we've had two central banks certainly shifting to more hawkish than anticipated, as the Fed had done through from December, but really in earnest that we saw that in January, which then obviously undermined confidence in stock indices and the stock markets. We saw a move to higher yields, lower bond prices, moves to higher yields across bond markets. And then we also saw a significant move lower in equity indices. And we've seen the euro yesterday surge high, the pound and the euro both enjoying strong gains against the dollar weak across the board in here, as we kind of went through an erratic phase, but really being driven by that euro strength in here. Kind of euro strength. Often when you get the euro rallying against the dollar, which we saw yesterday, then you get a knock-on effect that everything rallies against the dollar, even though really for the main reason for the euro rallying was a very much a euro-centric. It was all about the euro and the ECB. It wasn't about the dollar, but then most other currencies gained also versus the dollar, and was retain a short-term positive outlook. And obviously with the dollar index being made up by a large part, over 50%, from the euro versus the dollar, EUR USD, then the dollar index moved significantly against the dollar. So a significant sell-off in the dollar index yesterday. So that was the tail of the tape yesterday. The other thing we had yesterday, which was after the close, and I've got here today's earnings calendar, we're going to go to yesterday's earnings calendar, was Amazon, where we see a significant beat in here on the EPS. Look at that earnings per share, 3.71, 27.75. Good forward guidance. They hiked the price of the Prime membership in here. Things looking good across the board for Amazon. Amazon leapt higher, surged higher in late trading, after hours trading, and pre-market trading. And what we saw yesterday, actually, just after the close when the Amazon data was out, that all the negativity that came from the previous day, when remember we had the Facebook after the bell, after the close, back on, then that was Wednesday. So if I go to this week's data in here, when we had this Wednesday data in here, Facebook, Meta platforms, although it was only a small miss, it was more the fact that their number of users, the daily users, fell for the first time in history. Basically a 20% sell-off in Facebook, and that dragged all the stock indices down, particularly the Nasdaq down yesterday. It was looking really, really weak on the bell, on the close last night, and then we saw a really strong rebound in here across the stock indices, across the S&P 500, driven by the Nasdaq, driven by the surge higher that we saw in Amazon in after hours trading. Okay, so but then all of that, then since this morning, we'll talk about it, we're going to look at the charts, a lot of those gains that we saw in the stock indices indices, even though Amazon has held on to a lot of its gains, a lot of the gains that we saw in the stock indices from last night, overnight, and the futures markets have been given up into this morning, as we've seen European stocks push lower because of concerns about a more hawkish ECB, because of a concern about a more hawkish BOE, and also because of that still hawkish tone from the Fed. So all of that, three central banks now, all shifted more hawkish over the last 3 to 4 weeks, has seen stocks, back lower again in here this morning. Even though we had that stellar data that we saw out from, we had good numbers from Google in here, but yet last night, and then bad numbers from Facebook on Wednesday, and then we had stellar performance from Amazon last night. So if we go to, and then going into looking ahead into today now. So if we look ahead into today, so I need to jump back on the calendar in here, go to today. All the focus now into today is on the US employment report, and we'll come to that shortly. Let me just run through, and on the earnings side, it's very light for today. We don't have anything of real interest in here. Bristol Myers Squibb is already out in here. So, and really, I'm going to probably not focus on, maybe to have a little dip into the earnings calendar next week. We've had the majority of the earnings are out now. We have I think it's over 75-80% of earnings of the S&P 500 are already out. And the major FANG stocks have all reported, the major big tech, the big stocks have reported. We have a couple of standouts next week. If we just jump to this, I think we've got Disney and Coca-Cola next week are going to be standouts. Let me just check that I've got that ticked in here. So I think next week, Disney and Coca-Cola ring a bell. What else we have? So Monday, nothing of, so that's this week. Let's go to next week. So Monday, nothing of note. This week, next week, come on. Oh, here we are. So nothing on Monday. We get Pfizer. That might do something on Tuesday. Wednesday, Disney. Thursday, Coca-Cola, PepsiCo, Philip Morris. So, there are some biggish names in there, but they're probably not going to massively impact into the indices that we're looking at. So I'm probably going to take a little less of a focus on there going into next week. 5 things to know your day. What's coming up? Well, what's coming up? Payroll. Okay, we're going to talk about that shortly in here, but maybe a reduction in what we're expecting, because there's an article in here from Reuters. So Omicron surge likely slowed US job growth, losses possible in here. So the expectation is for 150,000. If we go to the calendar in here that we had from investing, so the NFP number, the non-farm payroll number, where are we? 150,000 expected, with the unemployment rate expected to stay the same at 3.9% in here. It means that, so it says in here actually, the number range from a 400,000 decline to a 250,000 increase. So there is risk that we actually see the number fall. Okay, so there's a range in here from Bloomberg as low as a 400,000 decline, and that's because of the impact from Omicron up to 250,000. So consensus 150, but don't be surprised to see a number around zero or a negative number in here for the non-farm payrolls today. So watching out for that. And if anything, a low number is going to probably be perversely, kind of counterintuitively, it's probably going to be good for the market. If we see a low number, if we see a number near zero, a number that's negative, don't be surprised to see the market rally on that. When by the market, I mean the stock market, okay, the equity indices. Don't be surprised to see equity indices rally on a weak number. Although it's kind of counterintuitive, it makes sense in the context of what we're worried about right now. What are the markets worried about? They're worried about a tight labor market. They're worried about inflation. They're worried about hawkish central banks. If we have a weaker employment number, it means potentially a looser labor market. It potentially means less inflationary pressures, and it potentially fewer inflationary pressures, and it means that maybe the central banks back off slightly. Okay, so don't be surprised to see a weaker number being seeing a positive reaction from stock indices. What else do we have in here? Record books for tech. So earnings. So we had. Meta. Okay, so the earnings driven guys are giving whiplash, with Snap surging more than 50% in after trading, and is yesterday's session 24% lower. Amazon results pushed the Nasdaq higher. We've already spoken about that. Meta posted, so last night, if it depends where Amazon opens up, but if it opened up where it jumped to last night, it was going to be the biggest, depending where it opens up later today, but potentially the biggest value, absolute amount. And obviously the absolute amounts are going up all the time, but to a stock index an individual stock in one day, with Meta the day before posting the biggest ever wipeout for a stock. I think it was over $250 million, right, or something like that, wiped off of Meta on Thursday, potentially for a huge big number on the Amazon Open today. We've spoken about this already, the hawkishness from the Bank of England and from comments from Christine Lagarde at the press conference. So potentially 50 basis point tightening from the ECB by the end of the year. Market saying mixed in here. Well, market's actually probably lower, if anything, maybe from since this was written. Let's take a run through a few of the articles in here, but most of the stuff I've already mentioned in here. So this is the equivalent to like the 5 things to start your day from Reuters, their morning bid. Troubles come in 3 or more. They're talking about, okay, we had good numbers from Amazon, but in here talking about the negativity from the sell-off from Meta, plus we had the negativity, so there's the big sell-off in Meta, the Bank of England and the ECB switching to a more hawkish tone in here, and then obviously we're now in the focus on going into and then Amazon done well as well. So so the market in here is going to be really interesting today, and you've got obviously the employment data as well to add to the mix of what was going to be a busy day anyway, given that the what happened with Meta and then what happened with Amazon last night. So Dover stock stage tentative recovery after Meta rout. And earnings whiplash points to more volatility for US markets. Yeah, we know that, and we've been seeing that, and that's going to continue. European stocks, getting hit today, between 0.5% and 1% down. 1.5% in some places. Not liking, obviously, for the European stocks in here, their currencies are rallying because of the more hawkish central banks. The pound is up, the euro is up. That's negative. Remember, stronger currencies are negative for the any corporates that are working in those currencies. Okay. So a negative impact from the currency potentially weighing on, as well as the fact that we saw the sell-off from Meta, and then although we saw a rebound from Amazon, that's not coming through in the futures in here, giving up a lot of the stock index futures in the US, which we'll come to shortly, giving up the gains that we saw last night with the rebounds that wiped out a lot of the Meta losses after the bell last night have been given up already, and we'll come to see that on the charts in here. US stocks in here, so these are the sell-offs from last night, but we go to the futures. Just loading in here, but we'll come and look at the charts anyway in a second. But you'll see that the futures markets, having given up, they're down the same as the cash markets in here, having given up the rebounds that we saw last night. There was 1 point last night. So in here, the futures, look, we're down. Down on the Dow Jones. The S&P is only slightly down, and the Nasdaq actually up. The Nasdaq is actually up. It's holding on to some of the gains, having had a very weak close, but holding on to some of those gains. In here, we also have European stocks falter, bond yields rise after ECB pivot. So ECB have changed, and then again on the ECB in here, ECB absorbed a 2022 rate hike in policy turnaround, and we've spoken about Omicron in here. Let me just get rid of these in here. Sorry, guys. Right. So a couple of other articles in here. Forex Live, European Morning News. Euro gains further. So the euro's further up this morning, having had a really strong rally yesterday. And oil putting still higher on the day in here. Yet another multi-year high. Targeting $100. Yeah, $100 potentially in February. Okay, so we're up 91.60, up 1.5% on WTI today. Let's take a look at some charts. So look, this is the S&P 500. So look, yesterday, big sell-off, right? Big sell-off because of Meta. We'd already sold off a bit on Wednesday. Meta sent us all the way down here. We were down here on the closing bell in here on the cash market closes, and then we saw a really strong rebound. We'll take a look at that on the intraday chart shortly. Really, really strong rebound from the Amazon numbers, the huge Amazon numbers. But then look, we've given that back since then. If we go into the 30-minute chart, so in here, the market's spiking lower in here because of Meta, down because of Meta. Okay, then here's the close, a really weak close. The market was always down here on the close. Okay, and then look, boom, that's the Amazon data all the way back up here. Got back all the losses on the day, and then held in, and then over this morning during the European session, market has given up all of those losses, all of those rebound gains from here and more. Okay, and we're just about holding at pretty much where we closed out last night before the Amazon data. So we're back down. So Amazon data in here not being reflected at all in a positive way, with actually the S&P 500 making a new low on the future overnight. Okay, so you'd have to say that I was clinging after this kind of rebounding here. The market, the real risk is that this turns more negative. Now we have rebounded off this low. I think it's a tricky one. Hold a gun to my head, you buy it because of the Amazon numbers, but then you know what? You have a stop right below, not only a stop and reverse below today's low. So, definitely exiting any longs in here. If you want to sell it, you probably wait for a bigger rebound in here, back up into here on either the US employment data, or you wait for the cash market open. So, but all eyes really on the employment data in here at the moment. Okay, to probably get the lead for where we go for the rest of today. For me, there's still, I think the easy trade is to buy it and have a stop it and reverse below the low in here. And it's the same for the Nasdaq. We go to the Nasdaq in here. So look, there's the big sell-off. We were all the way down here on the closing bell, and then boom, really strong candlestick back higher. That we saw from the Amazon data, and then look, giving back a big chunk of that. Although we are still up from where we kind of ended up the day last on the closing bell last night. So there's the Amazon data there. Okay, so we're actually up from from the Amazon data. We held that low. So the S&P, remember, made a new low. Go to the S&P in here. The S&P made a new low here, undercut the low on the daily. If we go to the 30-minute chart in here now, the market's held above the low from yesterday, and it's holding above the impulse point from Amazon. Okay, so again, playing this probably from the long side as well, but be super careful in here. It's got to be super careful in here today, and obviously you just reacting to data. Try not to hold positions through the data, guys. Enter through. Once the data is released, quick entries after, but try not to enter them into the data. Let's take a look at a couple of the other charts in here. Gold in here continuing to eke out gains in here, higher highs and higher lows since the sell-off that we saw. From a big sell-off in here from last week, continue to eke out gains, higher highs, higher lows, another new high in here. I think you have to play this one tentatively from the long side, looking for the next swing down in here towards maybe 1808, 1807 to go long, or maybe just to break above the peak. And let's take a look at oil as well. As we know in here, oil, yet another new high. Surge, dip and a rebound yesterday through OPEC, new recovery high, yet another new recovery high in here, looking super, super strong and expecting more to the upside for oil, but probably not wanting to enter in long in here right now, okay, at these levels, okay. Let's take a look at the dollar index. Again, big losses yesterday because of the euro losses, further losses today. Again, the euro making further ground to the upside. I think you can sell this one into today. We are getting towards oversold territory here on the daily chart, but I think you can go short the dollar. I think this has potentially got more to the downside. All right, guys, I'm going to wrap it up there. Good luck in the countdown to the NFP. Helmets and goggles on, ready for NFP in here. I'm going to wish you all a great trading day. Thank God it's Friday. Have a great day. Have a great weekend. Stay safe. Take care. And I'll be back with you with another Bull versus Bear webinar on Monday. Bye.